Thanks everybody for joining us. My name is Anthony Cimino. I lead the public policy team here at Carta. And as mentioned, we've talked a little bit about how companies are valued and its implication on equity compensation and tax. It's a tough act to follow from Christopher and Shelby, but what I'm going to talk a little bit about is how we save you additional money on taxes by arming you with qualified small business stock knowledge and attestation. So first, let's talk a little about QSBS. What does it do? Well, it exempts shareholders. Those are the investors in the companies, the founders and employees on this virtual event from capital gains. So just to say it plainly again, if you're able to take advantage of QSBS, you can avoid paying capital gains taxes. Now, before we go into the logistics around that, I want to set a little bit of context and ask the question, well, why is that? Well, the why is because policymakers want to drive capital and talent to the innovation ecosystem. Startups and growth stage companies drive the bulk of job creation, as well as the innovation that's fueling tomorrow. And they also understand that that is a very high risk segment. A third of the businesses will fail after a year, half fail after 5. And so the goal is to incentivize investment in these companies and help reward talent to join them and help build. And QSBS is a tax provision that does that. So now that you understand the what and the why, let's get to the how. So how does QSBS do this? Well, first, there's 2 components here. QSBS eligibility is determined by the company as well as the shareholder. So let's start with the company. To be QSBS eligible, the share needs to be issued by a C corporation. And that C corporation, at the time of issuing a share, must have gross assets less than 50 million. So again, a C corporation with less than 50 million in gross assets. Now, importantly, that company needs to be operating in a qualified trade or business. Now, this gets at how we think about what universe of companies are eligible for QSBS. And policymakers did draw some bright lines here. And so we can share broader examples and consult the IRS code, but just from the top here, something like a pure insurance company or a farming business or the operation of a motel or restaurant wouldn't be considered a QSBS eligible company. And important and related to that, 80% of the company's assets must also be used in the active conduct of that trade or business. What this is getting at is the company's balance sheet and shouldn't be used for things like commercial real estate if you want it to be commercial or QSBS eligible. So just to recap the high points here, needs to be a C Corp with gross assets less than 50 million and ultimately operating in a qualified trade or business. So that's the company piece. What about the shareholder piece? Well, for that puts a lot of the power and frankly, in position on you all to understand it. So in order to have QSBS eligible shares, the employee must receive the equity grant or exercise the option while that company is still QSBS eligible. And where you see this get tripped up a lot is when the company might issue a grant when it's below 50 million in gross assets. But as that company grows, if an employee hasn't exercised that grant, it loses its eligibility. And that's why it's really important to note that the exercise must be done or the shares must actually be in the equity form at the time the company is still QSBS eligible. Now, the second piece here is that the shares must be issued or acquired directly from the company. This is something that matters more to investors, but it's really important to note that you can't necessarily buy QSBS eligible shares on the secondary market. The shares must be issued directly from the company. And this last piece is very key. You must hold those shares, that QSBS eligible share, for 5 years before you sell it. And this gets at the long-term nature of whether it's the investment or the kind of, if you will, commitment of earning equity at a company and holding that for a specific duration, in this case, 5 years. So that's how QSBS eligibility works. But let's talk a little bit now about an example of what it actually looks like so you can take it out of the concept and bring it home. So I've got the same fact set, but viewed through 2 different prisms here. Now, one is going to go through what QSBS eligibility looks like, and another is when you don't necessarily have QSBS eligibility. So in this case, an employee is issued a set of options. And to exercise that set of options, it costs $50,000 or so. The employee works hard, helps build the company. the company's successful, the equity itself grows and appreciates. And 5 years later or more, when the company goes to sell the share, when the employee goes to sell the shares, they net a profit of around $950,000. Now, because they exercised those shares when the company was QSBS eligible, and because they held that stock for 5+ years, they're able to benefit from QSBS and not pay capital gains. Now, an important caveat here is this assumes the state law reflects QSBS and there's not additional taxes assessed on a state level. But for purposes of this exercise, we're largely looking at through the federal lens. They're able to get that $950,000 without taxing on capital gains. Now, the second scenario is the same fact set. The employees issued that equity and it cost them, issued those options. It cost them $50,000 to exercise those options. And the company goes through that same journey. The shares appreciate and ultimately the company decides to IPO. And that's when the employee decides to exercise and sell his or her shares. Now, to be clear, that is a perfectly rational decision for many people. And tax planning and equity planning is something that everybody has to kind of assess on their own, ideally with the help of information and experts. But it's not only a perfectly rational idea, it's something we actually see quite often, where an employee might exercise at the time of IPO and sell at the time of IPO. But doing so has implications here, because that $950,000 of profit does not have the benefit of QSBS because they waited to exercise those shares and lost QSBS eligibility, and then ultimately sold them during that IPO as well, or in that short time period. So the tax piece here actually cost them approximately $351,000. Now that's a substantial amount of money. Now, an important piece here about QSBS, which we should acknowledge, is that there are caps on this benefit. QSBS's benefit is limited to 10x or $10 million, whichever of the two is higher. Beyond that, you still would get your proceeds, but the capital gains tax on the proceeds above that ceiling would start being assessed. Now, again, 10 million or 10x your basis, whichever is higher, those are good problems to have. And I wish you all the best in that front. But ideally, you're able to take advantage of QSBS for that amount between that 10x and 10 million. So now that we've talked a little about what QSBS is, why it exists, how it works both in concept and practice, I'm sure a lot of you are thinking, does this actually apply? Am I eligible for QSBS, despite walking through some of the companies and shareholder obligations? Well, I put this chart here because CARTA very much operates and supports the infrastructure for private markets, and that is a universe where QSBS is very prevalent. And as you can see here in this chart, over the last 5 years, we've seen the number of employees that have QSBS shares grow and the value of those shares grow. Ideally, most graphs do go up and to the right, and this one very much does. So in the last 5 years, we've seen a 362% increase in employees with QSBS shares and a 216% increase in the value of those QSBS shares issued. I show this to you all to really help pound home the point that QSBS is something that you should look into, because more likely than not, if you're on this virtual event, you've got the opportunity to take advantage of it. I can't guarantee that, but this very much matters to this ecosystem. And what we want you to do is be informed and be able to take advantage of it. So that's a little bit about QSBS. But of course, there's nuance and things to consider here. And so we wanted to flag a few of these issues to consider. And I've broken these down into 3 key categories: what I call points in time, ambiguity around the treatment, and policy changes. So let's talk a little bit about points in time. Now, as we mentioned earlier, as companies grow, as changes happen, QSBS eligibility can be called into question. I refer to this as points in time because it's important to understand that when your shares are issued or when you're exercising them, you've got to lock in that understanding that you've got QSBS and the attestation around it. And I'll use an example here of recently a court case in Zhu versus the US found that despite certain financial records in place, a tax filer and a shareholder that wanted to claim QSBS couldn't. And the reason was because they had financial records to prove that a company's gross asset threshold was below $50 million for years after their shares were issued. not the year their share was issued. And so even though one might assume that a company's growth is up and to the right, linear, or whatever pattern, that in a future date, since the company was still under that $50 million asset threshold, any year prior, the company would have been under that $50 million asset threshold. A court found that that couldn't be proven. And as a result, that QSBS treatment wasn't provided. And so we think back to the fact that you've got to hold these shares for 5 or more years, understanding that this is a share issuance or an exercise that's happening at a point in time. It's really important that you understand the eligibility and lock in that treatment and clarity around it. And clarity goes to that next point. And that's the fact that as much as we try and create real parameters and black and white treatment around who is eligible for QSBS and who isn't, what the companies look like, how the shareholders need to operate, there's always a bit of ambiguity and gray area. And whether that's because the business model type, as I mentioned, some firms are in, some firms are out, but there could be caveats or nuance to that, or there could be cash management issues that adjust around that $50 million asset threshold. Ultimately, what we want to do is provide as much clarity as possible. And so when your shares are issued, you exercise them, you accept them, ultimately, it's really important, similar to that point in time piece I just mentioned, that you get clarity and ultimately lock in that treatment.